This is a trade review for some gold trades during the London session on Friday the 12th of September. Had a pretty sick session and caught a few really interesting trades. The main one I want to talk about is this long, which used a really key signature that I've been using this last week, and I actually found multiple trades and actually took multiple trades using this signature just yesterday on NASDAQ as well. And it's extremely effective for knowing which lows and swing highs are actual reversals. So I'll talk through that in a bit and talk through this trade in general. You kind of see what I've got marked out on this chart. I'll jump over to a clear chart, however, and just give a bit of context. So all-time highs up here. We've engineered the sell side down here. We took it out once, took it out twice. And then this is at CPI. So CPI creates this really long wick and then goes sideways. This is a framework I call a long wick plus no gap, which is when you have a long wick and then we fail to displace in the opposite direction. What that tells me is that we are creating the narrative that people see this as a bearish rejection, and then they are selling below that level as buy side accumulates up here. So that actually creates a really nice long opportunity as well, which I can talk about later as well if I have time. But that was essentially people selling below this price, meaning that there are trapped shorts down here. We then have this buy side pull and we're going to hit that. So when we're pulling back into this range, I'm expecting that we won't need to come all the way back down here. And the reason why is because this is the previous day high. Did we take out the previous day high? No, we came really close to it and then traded low. So I'm anticipating that previous areas of accumulation will remain intact. When we are in a buy program, meaning that we're targeting buy side liquidity, so old highs, we like previous areas of accumulation, such as this, will continue to hold price. I don't know exactly where in this range it's going to come down to. Is it going to come down to this wickless candle, which is just about wickless, or deeper into this area? But I knew that it would come down here to some point, and I was expecting a reversal. Now jumping down to a lower time frame, I'm then looking in this range to see, okay, what swing highs and swing lows stand out to me. First of all, this one, because on the 15-minute that's a swing low. But as you can see, we displaced below it quite aggressively, showing the intention of going lower. Then if I drop down to a 5-minute chart, we start to see the picture a bit more clearly. So on the 5 minutes, we have this swing low. So the most discount impulse low in the entire price leg, and just happens to also be the swing low that takes out the CPI high. So we engineer that low and then rip higher. A lot of people see this as maybe a demand zone. And so we'll be trying to buy there, put the stops below. So we know there's a bunch of sell side below that. Also, we have these old relative equal highs. That indicates that there is liquidity there. Because at highs and lows, it doesn't matter if it's highs or lows. There's always going to be both buy side and sell side liquidity there. So just the fact that we're at a high or a low, you can use that as a reason to expect there to be liquidity. And because this was the most discount impulse low, it had my attention. Now I was looking for a impulse rejection, and essentially what that is when we hit an impulse low and we reject higher. The antithesis to an impulse rejection is if we get an impulse rejection failure, which would have been if we had initially rejected the low and then closed right back below it and then continued pushing lower. That would have been an impulse rejection failure, which could have been a continuation short. But in this case, I wanted that rejection back up, so I was looking for that. Now, if we go down to the 1 minute, that's the daily. I saw the 1, I just didn't see the 1D. Zoom in a bit here. We've also got the context of this sell-off. So this is the overnight sell-off. I'll turn on an indicator real quick, hourly open. So this shows you all the hourly opens. So we have midnight all the way up here at this yellow line, then 1 a.m., 2 a.m., and so on. 2 a.m. opened and sold off. Below 2 a.m. is a discount. and then we continue pushing into a deep discount on that 4-hour time frame and down to the lows. During the sell-off, anyone who's chasing the short, they need a place to trail their stops. So above these highs, above that high, above this high, above these highs, there are going to be stops. We have this impulsive move lower. So once again, impulsive highs and lows have my attention. They are very, very nice liquidity levels. And after that impulsive drop down, we then go sideways. So anyone chasing the short, they're going to get short in this area and likely put their stop up here. Anyone who sees these relative equal highs as well, so people see this as resistance. And resistance means that you can short below it and put your stop above. But I don't know how support and resistance traders usually trade, but I assume that they don't put their stop loss right here. They more likely think, okay, where's the next level, like a really strong looking high for me to put my stop. So I would imagine some unprofitable traders could be doing something like this. I really like that because it means that this is what I call a delirium framework, which is where you have an impulse high with relative equal highs below it, the same with low and relative equal lows. And the idea is that we won't just go to these highs, we'll go up to this high. So that was also really nice, knowing that people were trying to trail their stops to these highs as well. We then create this really long wick at 504. So a long wick also looks like a bearish rejection from that same level of resistance. And so I've got plenty of narrative behind me that everyone is getting short. Now we hit that key point of interest, that 5-minute impulse low. Initially get a nice little push up from it, put into another very long wick, so I really like that. And now I'm watching as we drop back below it. At this point it's looking ultra bearish. But what gave me the confidence to get in the trade? Well, there's a signature called the last second wick. I'll jump over to this one now, but the last second wick is when a candle of any time frame prints and the wick forms in the last, I usually go for about 25% of the candle's duration. So in a 1 hour wick, that would be the last 15 minutes. In a 15-minute wick, don't want to do the maths, but lasts 3 or 4 minutes. And as you can see, at 5:14, we rip up from the low all the way to close with a relatively long wick. On the 5 minutes, you can see that's rejecting the low really nicely. And then if we go onto the 15 as well, you can see that we did print a very nice long wick at that key level in a place where we were anticipating a reversal. So as soon as I see that, I recognize that this is likely a wick that will hold because it formed in the last moments of the candle. If this wick formed at 5:11 and then we were just sitting in here, then I'd anticipate we would be more likely to be enticing people to get long. So these kinds of wicks are likely to hold. Great place to get long. We then push up into this wick, easily getting above the midpoint. And you know that anyone who's chasing this short, their stops are here, their stops are throughout this wick, and more likely above these highs and this high. So really easy to jump in, put your stop loss below the 25% end of the wick, the lower quadrant. You could even do the midpoint, but just to be extra safe, put it down the lower quadrant, catch that run up, and then we get this nice push up. Now I caught the trade, but I actually was taking partials here. I was taking partials here rather than adding, but I should have actually been adding at this area. That's just to represent the relative equal highs and the support and resistance. But the reason why I should have added right here is because we essentially have a breakout above relative equal highs. So we're tripping in longs. We then drop back down to this old low. We tap into that old low and also respecting the midpoint of this long 15-minute wick. And then once we've done that, we had tripped in the longs, taken out their stops, and then come out for another breakout. And this is a way that I've seen breakouts seem to work, and I need to develop more models around it and frameworks. But initial breakout fails, takes liquidity, and then we go for an actual breakout. So that could have been a key point to anticipate the continuation and put a stop relatively tight, probably down below the midpoint of this range. anticipating that to continue pushing up to this key pull. So that is a very nice trade. Exact same concept here. Another trade that I took on a demo account just to test out the concept, but we had hit this impulse high. So once again, they are very key pulls to get reversals from. And when we fail to reverse from them, that usually gives you a mad continuation. But we tap into that high, we start drifting lower, we take out this low. So you'd be thinking, okay, this should really send us back up if we're bullish. But we also have this impulse low just below that really stood out to me, a long wick and plus a rally up. And you'll find on the 15-second chart, this wick likely only formed like at the start of the candle. And so because it was intentionally printed for the purpose of enticing traders. That's when we are about to reverse, that is a lot of the time the case. I'm kind of curious about that actually. Let's see if it's right. Yeah, where are we? Yeah. Not always, but a lot of the time. So yeah, so the low of that wick is at 5.15, and then it's basically halfway into the candle is when we reverse. The more time that we spend with an entire wick printed, so if we made the wick in the first 15 seconds, then just consolidated above it, we're more likely to be enticing longs, but that's kind of a distraction. The idea of this wick is that there's a long wick on the 5 minutes. First we took out the lows, rejected higher, but then just before the close, 1 minute before the close, we dump straight back down and reject these highs aggressively. So once we had that rejection, I recognized that we'd formed the wick in the last 1 minute of the 5 minute candle, and we had taken out all this buy side. I could see reasons to go lower, such as we just had this big rally. We hadn't taken out any trailed stops other than this short-term low. Also 6 a.m. new 4-hour candle had gone straight to a premium. So all of this is premium, hitting premium buy side, and then getting this last second wick. Great place to jump in short. Targeting, I actually took it all off at that impulse low. But yeah, if we can get better at just leaving a runner on, you can catch some big moves. Then just want to try and get through this video very fast because I want to trade the open on NASDAQ. In fact, I've already got a chart marked up on this. Actually, I'm still long NASDAQ. 1 second. Might as well put that up there. Where are we? Should probably take something off at the 50s. 2. Don't like that long wick actually. Let's see. Just do some quick trade management and then I will jump back on. Okay, that wick formed there. I think that should be alright to continue holding. I've already taken partials above this short-term high and above that short-term high as well. So I'll take 2 more off there. I'll leave that all the way down here for now. I'm expecting this to continue pushing. Quickly explain why. Essentially we had this consolidation above 24k, which is this level. So 24k, consolidated above it overnight. We'd already reached 200 points below the previous day. We then reach down once again, have a nice dump below it during London, and then climb back above. So at this point, we have already raided 200 points below. We've got back above, trapped people back above 24k, taking out their stops once again, taking out this impulse low. I can get rid of all this stuff. This impulse low down there, nice rejection from that. And then this was the key for me. No 24k retest. So after getting back above 24k, we raid out this low and then run straight up without creating any obvious low at 24k. That usually indicates that we're not planning on getting back down to that level. We then run higher, make multiple highs to the previous day high, and drop back down a bit. I see that we'd run out as this sell side here, so we've got a nice order block within this range, previous year of accumulation. Also this nice sell side down there before this enticing leg higher. We drop down into that, I actually put on a position right as we hit it, but then when I saw us print this long wick, and then this wick is also key, when I saw us print this long wick and then get below it, create another really long wick, which is where I got long, and then start rejecting back down from this wick, that indicated bearish order flow still, so I got back out. But then I was watching how we came back into this wick. We respected the midpoint. We started creating this structure in here, and we had this impulse high. This is the impulse rejection failure. We run above it, close back below, take out a short-term low, and then we get a closure back above right here. That was the entry signal. Because we had just displaced above this short-term high, I then used the midpoint of this wick to get in on the long, and with a stop loss below the failure swing low down here. That pushed high very nicely. We had all these impulse highs, as well as 828 enticing shorts, and then 830 enticing more shorts right after. The failure to get back below this while still rating below the 20s, which is that level, is what told me that was we'd just come down here to take out sell side and head back up. And now I'm expecting us to likely, hopefully, go a good 100 and 200 points above today. So that'll be the last partial for this position, and I'll see if I can just let it run throughout the day, keeping the stop loss below the midpoint of this consolidation. But yeah, and then quickly get back to this, and then I'll jump off. Try to be fast. So this is that framework that I was talking about, the long wick plus no gap. We have this long wick at CPI, and then no displacement away from it. Obvious buy side above, and yeah, so failure to displace low, trapping sellers, prepare for a short squeeze. If we drop to the 15 minutes, okay, I'm back. My screen just disconnected for a second there, so I had to restart the recording. But that's the framework, long wick, no displacement lower, so expecting that to rip back up. Now, how would you get involved? This is all in hindsight. This one, I didn't actually take this trade, but I was trying to figure out, okay, how would I have used it? This is another really key concept, kind of similar to the last second wick, a manipulation closure. So essentially, you're looking for either the midpoint of a wick or a old low. Basically, any PD array that we should not close below or a certain point in it, such as the midpoint of the wick, or below a second closure, below this low, which is an impulse low. We get that right here while we're rating, after having already rejected this low. We then close down below it with a closure, and what makes it a manipulation closure is if we disrespect that array, but then the very next candle rips straight back up. So essentially, you'd be watching as we hit this low. Okay, do we continue pushing below it, or if we initially close very bearishly, but the very next candle rips straight back up, then you'd look over to a lower time frame just to confirm that we've got that movement away, and then you can jump in. And this is what it looks like on the 5 minutes. You have that closure back below this old impulse low right there. Very next candle raids out the swing low and rejects back up, kind of a morning star kind of formation, and then that displacement and speed straight back up. That's what confirms that we have that 15-minute manipulation closure, and you'd simply enter trusting that we would not go back down below that swing low. Your stop would actually go below the swing low itself, trusting that push back up, and you can see that works out really nicely. And another thing I noticed was how we have another manipulation closure just below. Long wick, that took out a low. Usually you don't want to see us close below the midpoint if you're bullish, but we do. But then the very next candle, straight back up. So that was how I would have played that, and I will look for that in future. But once again, really cool to see that further obvious liquidity pull, and then this pull engineered just below it, and we don't stop there, we just keep on ripping straight to that level. Yeah, that will do for this review.